All right, welcome back to another episode of Asset Coach and Tax Strategist, and I appreciate you being a subscriber. If you're not a subscriber, go ahead and hit the subscribe button. If you like our content, give us a thumbs up. If you have any comments, please add those in the comment section. So what we're going to do is uh, lots of activity economically going on with the war in Iran, just a lot of stuff happening, and and let's be honest, human nature, media, mainstream media, or just our own feelings are designed to do a fight or flight feeling. And most people flight. It creates a fear, and in that fear is because of uncertainty, the unknown, what's going to happen, right? It's all these big questions. But fear is not a productive feeling unless you turn it into a productive feeling. Meaning, I fear something, but I want clarity of why I'm fearing something, so I can go fight, so I can go figure that out, so I can go figure out why am I fearful, and I have clarity of something, I have knowledge of something, and with that creates calmness, and that fear dissipates. So why am I talking about this? Well, because we have this war with Iran, right? And Iran, rightly so, is lashing out, right? And this is not a political conversation. We don't get into to politics when we're starting to talk about the economic termites. But the politics affect economic termites. So remember, economic termites are taxes, inflation, time, and then laws and regulations are our politicians. So we can follow all the rules, do everything we've been told, and the politicians change a law. It affects the rules, it affects what we've been doing, and all of a sudden we've lost the time that we've put into in following the rules and doing whatever we had to do. So I wanted to go through this conversation because I think it's an important dialogue and an important conversation to talk about. Let's take a step back and let's talk about, how is money really created? What is it, right? It's printed, and so most people think, oh well, when the Federal Reserve prints money and they create money, they just flip on the machines, because that's what we see is, these big printing machines, presses making all this money and stuff. But that's not really how it works. That's the somewhat the end result of the old form, where paper currency was so valuable and was so important when it was backed by gold. But now it's electronic, right? It's an exchange of numbers in a system on a computer. So let me break this down. Let me talk about the first step. First step is the government spends money it doesn't have. The politicians make a decision and they say, we're going to go do this, and they go do it. Well, as you know, living your own life, just to do this or that costs money. I'm going to go to the grocery store. It costs money, not just buying the grocery stores, but driving to the grocery store, the get cost of the gas. But I have to have a car, so I got to buy a car and I have insurance. You get the idea. Everything costs money when we decide to do something. Okay. Now, if we decide to do something and it doesn't cost tangible dollars, for example, my example of driving to the grocery store, what if I decide to walk to the grocery store? Okay, the currency changes. The currency no longer changes from the dollars that I've spent on the car, the insurance, the gas to go buy groceries. Now the currency changes to my time to go buy those groceries. Okay. So there's always a currency, but the government, when they spend money they don't have, they make this decision, and it affects the tax revenue, and they do not receive enough tax revenue to pay for all of their spending. Okay. So this is why Trump was doing the tariffs and going and trying to get another revenue stream into the country that didn't rely on you and I as taxpayers, and increasing tax rates that quite honestly have to go up to pay for their spending. Because if they stop spending, then yeah, we may start getting enough, but it depends on the spending, and which is part of why the Trump's administration is going after and saying, why are we spending money in all these silly areas? Maybe we should stop doing that and take a look at, just like you do in your own personal budget. You and your spouse sit there, or you sit there by yourself, you look at, you're like, man, I really should have more money. Where am I spending my money? And you start going through it and you realize, oh my goodness, I have streaming on Hulu, I have streaming on Netflix, I have streaming on Amazon, I have streaming on Peacock, I have streaming on Paramount, I have streaming on HBO. You get the idea, right? But I still have cable and I don't watch all of it. And so what do you make the decision? Stop spending money on that. You cancel. Okay. The same thing is true with the government. It is a business. That's what they're doing. They're going through their budget. They're looking at all their expenditures and like, why are we spending money in all these areas? What's the return? What's the benefit? What's happening? And when you start asking questions, what do you start getting? Answers. And when you start getting answers that you don't like the answers to, then you cut the cord. You cancel that expense. For example, my answer to the question is I don't watch all these. In fact, the kids have activities. Most nights we're out in the field or the court or whatever the kids' activity, piano lessons, whatever it is. Then we're not watching all this stuff. So why are we spending $800 a month on streaming and cable? Cancel it. That's your right. The same thing occurs in the government. Just because the government decides to spend money on something doesn't mean that that's a requirement to keep spending money on that, unless there is a benefit to society, to the government. Okay. And if there's not, as you and I taxpayers, we're funding that. Okay. So what happens is when that spending happens, the government starts writing IOUs. Okay. Those IOUs become part of the net. And so that's through treasury bonds, which is borrowing, right? And with the promise to pay interest to those people that the government's borrowing from. Okay, that's what the U.S. Treasury issues bonds and notes for. Okay, that's the reality of it. And so every period of time when we look at the spending, that affects the balance and the outcome and the value of a dollar. So number two, then the Federal Reserve will create new money. Okay, so that IOU is created, that treasury bond, the borrowing, the spending of the money. Then the Federal Reserve will buy those treasury bonds. Okay, and then what happens is that, there's no real money that the Federal Reserve is using to buy those treasury bonds. It just creates it new electronically. So they go into the spreadsheet, they type in a couple numbers, they hit enter, and voila, there it is. Now it's real. Okay, but it's not real. Okay. And then as we go through this process, because there's no paper, they're not taking, oh, here's $1 billion of cash. We're going to take it from here. We're going to put it into that vault there. That vault is for whatever that budget item is. That's not what happens. And they just pull out of that vault when they need petty cash, right? That's not how it works. Okay. And so it's basically all electronic now. And that's how the raw kind of the money supply goes through. It's not paper cash, digital dollars. So it doesn't really exist. Then step three, what happens? Banks multiply that money through loans. So all of a sudden the Federal Reserve says, oh yeah, we have these funds. And then the banks, what do? They start go and lending this money out. And they create new reserves and start lending. And they're adding numbers, hit enter, and voila, there it is. It's there. So then when the banks approve a mortgage or a business loan, it doesn't really hand you something else deposit. It really creates a new deposit in the account. So when you deposit money, yeah, you may be doing a check and it may be real, but it's not staying in the bank. What's it doing? It's immediately going into the system. Okay. So that's why when you cash a check, that money's in the system. It's electronic. But what do? They hold it till you have access to it. Why? Because they're starting to lend it out. They're starting to make money on it. And it's in your account, but you don't have access to it. So you can't spend it, but they've already started using it as a leverage collateral in their lending. So even if it's a 0.01% on that dollars, when you look at billions and billions of dollars deposited daily, these banks are making that contribution or making that revenue from the lending it out, even if it's just for a couple days. Okay, that's how all of a sudden the dollar supply is in circulation. Now it's active. So the step four is when we have more dollars but the same goods. That's inflation. Okay, so all of a sudden now we have to go buy our goods and services again. So go back to I'm going to the grocery store example and scenario, and the gas bumped up. It was at $2.30. This is not for California audiences. So it's at $2.30 a gallon. And all of a sudden it bumped up because of the Iran war. Now it's at $2.89. Oh, well, that's inflation. Same product, higher cost. That's inflation. So when you have too much money chasing the same goods, that means your savings is less. Your paycheck buys less. You buy less. Okay. So when you go to the grocery store or you go to McDonald's or you go someplace and you're like, man, as a kid, I remember these hamburger patties being bigger. They were. They shrink the meat. The price stays the same, but they shrink the product. That's inflation. They leave the product the same. They increase the price. That's inflation. Okay. Something has to give in that formalization, that calculation. Okay. So then while you and I are paying higher prices, this debt-based system keeps expanding, just keeps growing. Okay. So then step five, who wins and who loses? Well, inflation is a hidden tax. This is why we call it an economic termite. It is a tax. It is the deterioration of your purchasing and buying power. It punishes savers. So this is why in previous videos we were always talking about when you're putting money into savings, it's being stored because it needs to go into an asset. So we have a lot of members that invest in the stock market. That's paper money. There's no reality to that. You don't control that. We'll talk about that here in another episode of what this looks like. Okay. This is very important to understand when you understand that how money is really created. If you don't actually have a physical asset, so if you don't have gold, Bitcoin, now people say, well, Bob, Bitcoin's not physical. It's finite. It's a value that is created that it's structured. Gold, you can go mine more gold until it's all gone and depleted. We don't know when that happens. So that price is based on supply and demand, right? So if there's less supply and there's high demand, the price of gold goes up. So what happens if they start mining and they create more supply? They create more supply, what happens? And the demand is the same, the price of gold goes down. Unless the supply and the demand are matching, the value goes up. That's basics of supply and demand. Bitcoin, there's only so many Bitcoins. It's finite, not infinite. It's finite. We know what it is. And so when the demand increases, the supply is still the same, the price goes up. Okay. So same thing with real estate, physical asset, business, physical asset. Okay. So when we're looking at this type of stuff, we need to understand, okay, a paper asset in the stock market liquidity. That's why they keep telling us and trained us as advisors to gather assets, to I'm going to get paid on gathering assets. I'm going to gather $10 million in other people's assets, and I'm going to get paid a fee for that. Okay. Now, those assets are all paper, but then it's not reality, is it? It's just keystrokes, like we were just talking about, huh? Just like we were just talking about. So in this five, who wins is the savers don't win. The savers lose. The people who win are the actual ones that are the debtors, the investors, the ones that are purchasing assets, the one who's putting money behind this. This is why when we talk about this business partnership and this relationship with the IRS, is that you and I have the cash. We're putting it into things that the IRS gives us tax benefits from. And they give us more tax benefits in certain areas because what they're doing is telling us those are areas that eventually generate revenue. For example, when you go buy real estate, why do you go buy real estate as an investment? Because you're going to have a renter, it's going to create cash flow. So why do you think the government gives you tax benefits for that? Because they want to take care of you, make sure you feel no, because it ends up creating more tax revenue for them. That's the key. Okay. Unless you understand how the game's structured. So you don't want to be a saver. You want to be a debtor. You want someone who owns assets. And when you use debt to buy assets, that lets inflation to pay off your loans. So when rent increases, the cost of living increases, rent goes up. Does your mortgage payment go up? No, it stays the same. So that goes up. So you have more money to pay off the fixed dollar amount. Okay. So actually inflation works in your advantage when you have that structured payment. Okay. So holding those real assets allows your assets to rise as the dollar falls. Okay. And that's what creates that separation, why the wealthy keep getting wealthier, because they're not losing value, they're gaining value based on these assets. So it's really important to understand this. Hopefully this made sense. If you have any comments, add those below. Stay tuned to the next episode. Be very so. If you haven't subscribed, hit the subscribe button so you get notified. Every Thursday we drop an episode for the next episode. The next episode we're going to talk about Warren Buffett and what he had said about wars. Since we're in this war with Iran, I want you to understand what this means. It continues this conversation, this series, if you will, of how is money really created? What's this look like? How is money really printed? What's this look like? Warren Buffett just retired, but pretty much one of the only companies in the top 10 of the S&P 500 that is not a technology or oil company. It's a conglomerate. It's basically the S&P 500 in one company in Berkshire Hathaway. So stay tuned to that next episode. Thanks so much for subscribing. Make it a great day.